Crypto miners face margin calls, defaults as debts come due in bear market. Private and publicly listed crypto miners owe up to $4 billion in debt used to finance the construction of gargantuan facilities across North America, according to industry participants and data compiled by CoinDesk. Margin calls are coming for cryptocurrency miners as the bear market continues to claim victims. Here's where things get interesting too. I did want to bring this up. There does come a point where these miners will just not be able to sell you the Bitcoin for the price it's currently at, right? We've dropped down to 19,198. We looked at some of the pricing early last year, and it looked like you could produce a Bitcoin for around 13,000. And that was also not really taking into account infrastructure upgrades, etc. So really, the adjusted number from what I've seen has been around 22,000. So we're definitely under that 22,000 mark right now. But as these margin calls happen, they still got to pay. Of course, you'll have that initial liquidation, but then it will come to a point to where everything will settle back out. So you'll have a big dip in the price as miners liquidate everything they can to meet the margin calls. These companies will disperse. You'll have a lot of M&A happening, all that sort of stuff. You'll have a lot of acquirement going, from one mining company buying out another mining company. And then once that's kind of resolved and the miners that are basically cash flow positive take hold again, it should drive the price back up in relation to the actual cost it takes to mint a Bitcoin. The private and publicly listed crypto miners have racked up debts anywhere between $2 billion and $4 billion to finance the construction of their gargantuan facilities across North America, according to data compiled by CoinDesk and industry participants. As the value of the miners' output dramatically falls along with the price of Bitcoin, they have to make tough decisions about how to survive, including selling off hard-earned coins and equipment. Quote, "It was painful but necessary," end quote, Alex Martini, CEO of mining hosting firm BlockFusion, told CoinDesk regarding the selling of millions of dollars worth of Bitcoin reserves to service the firm's debt. Now, BlockFusion has a cash reserve to last about 6 months, but if the market doesn't turn, the company will be forced to do another round of liquidations, he said. And I hate to say it, buddy, but you're gonna have to do another round of liquidations because you did not time that halving cycle properly, my dude. You ended up in a position where you did not get a cash position out during the bull run that was going to last you to the next halving. And that is really where we sit down, especially as Bitcoin miners, and we be honest about what has happened. We look at the history. We are aware of the history. And anytime you see euphoria, you say, boom, get me a cash position to survive the next bear market. And that is where you end up being at if you want to strategically survive as a cryptocurrency miner. We've talked about this before, some of the mistakes I made where I should have put in, a liquidated. It's about, I think I had like 20,000 that's kind of just gone away, right? And I could have used that cash position to further survive the farm a lot easier than now the position I'm in too. So I made that mistake as well. The mistake that I didn't make though, of course, that these ones obviously have much larger debt ceilings and like that debt's going to come due. So they're forced to sell off the cryptocurrency they're mining. Whereas my strategy now is I'm not selling any of the crypto. I'm utilizing outside consulting. I'm utilizing YouTube revenue. I'm doing everything possible that I can do to make sure that I hold all of the cryptocurrency that I mine during this time. And this is it's cyclical. Like I said, you should be able to see it. And if I look at their strategy here and they got, enough cash reserves for 6 months, I look at the timeline, I say, well, 6 months is going to put us into 2023, which is probably going to be the hardest year for cryptocurrency and markets in general that we've ever seen to date. And I don't think that they're going to be able to survive. They're going to have to liquidate. So just pay attention. BlockFusion is far from alone in this predicament. With the Bitcoin price at its lowest level since 2020, global processing power on the networks, or hash rate, near all-time highs, and energy prices climbing, miners' profit margins are shrinking. Older machine models are becoming unprofitable and turned off. The hash rate decreased by 11% between June 12th and June 27th. Miners once steadfast on their HODL strategy are now being forced to liquidate their crypto holdings to pay for the operating costs and loan installments. Completely opposite of It's so frustrating because it's completely opposite of the strategy that you should employ, especially if you look at history. Like, what are you doing? Bitcoin mining revenue in dollar-denominated terms per kilowatt hour has more than halved since the start of the year. Data compiled by Upstream Data President Steve Barber shows. Using newer generation machines such as the Antminer S19 Pros and WhatsMiner M30S Plus can make a big difference because they bring in double the revenue of older models like the Antminer S9, according to Barber's data. Duh. That's the way technology works. Welcome to the digital age, my guy. The miners that use the latest machines and have low electricity prices, less than 6 cents per kilowatt hour, keeping their overall costs of mining a Bitcoin below $10,000, can still make ends meet and fulfill their loan obligations, said Brian Wright, Galaxy Digital's vice president of mining. CoinShares investments analyst Alexander Schmidt told CoinDesk he thinks, quote, the majority of listed miners, end quote, are still profitable even with the price of Bitcoin around $20,000. Miners who don't have leverage and run the new generation machines, and there's some of those in the United States, they're probably still fine in terms of profits, said Yuri Bolovic. And they become better off. Why do they become better off? Let's think about this for a second. Because the miners that are not going to be good are going to liquidate their equipment, which means less hash rate on the Bitcoin network, which means more profitability for the miners that are able to survive this. So they end up being in a much stronger position, right? So who racked up the debt? Adding debt into the equation paints a darker picture. Publicly listed Bitcoin miners have borrowed at least $2.16 billion based on data compiled from June 14th investor note from securities firm B. Riley Financial, and including a $37 million loan disclosed by Bitfarms on June 17th. On the higher end, public and private miners have borrowed a total of $3 billion to $4 billion in loans backed by mining computers, estimated chief economist and chief operating officer of mining firm Luxor Technologies, Ethan Vera. Core Scientific and Marathon Digital are among the most highly leveraged miners based on their debt-to-capital ratios. However, their debt obligations are mostly secured promissory notes that don't mature until 2024 and 2025. Now, that timing is great, right? Because if you are looking at the halving cycle and your debt doesn't mature until the next halving cycle, then boom, like I think you're golden. That sounds good. The capital ratio is an indication of how high a company's debt burden is relative to its equity. The higher the ratio, the bigger the risk. Definitely go check out the link in the description below for a handy dandy balance sheet for all of these large miners, including Core Scientific, Hive Blockchain, Stronghold Digital, Marathon Digital, Hut 8, and so on. Remember, Hut 8's in the worst position, I believe, last time we checked, and we did basically a full-on analysis of this on Tuesday's show, so please go take a look there if you're wondering which public companies you should invest in that are miners. Northern Data, a German hosting firm, has a debt-to-equity ratio of 1.84. According to data reported to the German Stock Exchange for 2020, the highest among miners surveyed by CoinDesk. However, the ratio doesn't accurately depict the company's finances today. Northern Data's head of investors relations, Jens Phillips Bremley, told CoinDesk via email. The miner acquired some of its creditors in 2021, paying off debts, and at the same time managed to reduce a significant portion of its debts through the sale of a 300 megawatt site in Texas. The company has an outstanding debt of $20 million euro, which it expects to pay off by August of 2022, he said. Companies ideally don't tap into their assets to pay off their debts, instead relying on their revenues to cover payments. Many miners are likely not bringing in enough revenue to pay off their monthly debt installments for these loans, regardless of what prices they bought machines at, considering common loan terms, said Bolovic. For example, as the end of the first quarter, Stronghold Digital Mining had outstanding borrowings of $70 million to pay off by the end of the year, but incurred a net loss of $30 million in the same quarter, according to a filing with the U.S. Securities and Exchange Commission. The miner did not respond to CoinDesk's request for comment on the story. Miners that borrowed money to finance their expansion plans are now having to make tough decisions. Many of those loans are underwater today, and borrowers need significant revenues beyond the financing to remain current. So we always talk about good debt and bad debt, and I always say, don't invest what you aren't willing to lose, and don't take out debt to purchase anything. Personally, I just sold stuff that I had, luckily, that I've accumulated over the 30 years of my life, and got rid of like a ton of, like got rid of all my cars, all that sort of stuff to invest into it at a much lower level, obviously. But if you were to, this isn't financial advice. This is like if I think about it correctly, or if I'm thinking about it correctly, maybe you guys can have some insight on this as well. If I look at this, what I would say is when you want to accumulate the debt would be at a time when you're in a bear market, and then get yourself into a position where you're going to pay that off later. So why is that? Well, because obviously the price of miners are cheaper, but interest rates are raising right now pretty significantly. So you're in a very awkward position. I don't necessarily think you should ever take out debt. I'm just saying if you were to, you would want to do it when you can get the most bang for your buck, not when S19s are going for $10,000, but when they're going for $5,000 like they are right now, right? Equipment financing loans like the ones miners take out are underwater when the value of the loan exceeds the value of the underlying asset, such as Bitcoin mining machines. At the height of the market, when Bitcoin was over 60,000, companies were purchasing miners at $90 and $100 and even more per terahash, Bolovic said. That adds up to as much as $10,000 per machine, so he's going to cover it. The larger price tag means that the loan amount was higher. That means that the monthly payments are higher, he said. And if we look at something like BT miners right now, which isn't necessarily always the cheapest. They are about to have a 4th of July sale, by the way. We're going to be talking about this later for you guys too. It's supposed to be a pretty banging one. But if you look at an S19 Pro now, look at this price, guys. $4,650. So we're a 50% drop, right? Look at that. On BT miners, it's down from $14,000 to $4,650. That's absolutely insane. Firms that placed orders for mining rigs at the height of the bull market for peak prices with a significant deposit are now in a difficult spot to follow through, said Jamie Leverton, CEO of Hut 8 Mining. In due course, we'll see some defaulted loans, unclaimed miners, and acquisition targets, Leverton said. Miners that were 100% financed are less than 2 years old and are small without beneficial economics are likely to be the first ones to see defaults on the associated loans, said Von Hughes. Miners' difficulties in paying their installments engender risk for the overall ecosystem as they leave lenders exposed to defaults. Hut 8 Mining's Leverton says she expects miners to go into arrears. Miners have to prepare for the bear market during the bull times. That's what we were saying earlier. Think about how to manage the cycles, treasuries, and balance sheets, she said at CoinDesk Consensus 2022 conference in Austin, Texas last month. According to Van Hughes, lenders BlockFi and NYDIG have given out horrible credit that miners will have a hard time repaying given current market conditions. These companies do not disclose how many mining loans sit on their balance sheet, so it's hard to estimate how exposed they are. Man, guys, and when we talk about BlockFi, this is one where obviously I made the mistake. We made a video about it early on during the bull run, and I apologize for that, and we corrected it. But when we look at the fact that BlockFi is in an interesting position because what they were getting people to do is basically put in cryptocurrency, and then they were taking that cryptocurrency and they were loaning it out to miners. That's essentially what was going on. So now you're in a position where you have these high interest rates, which is how they were going to be able to pay the users out. And you have a whole bunch of miners that are going to default. Well, when they default, what happens to all of your funds that are in BlockFi? Poof, gone. So if you still have something in BlockFi or NYDIG, I'd recommend, and this isn't financial advice, right? Things could change and I could be completely wrong. I shouldn't say I recommend. What I would do, what I have done, is pull all of my funds out of BlockFi, right? Because it's not even, once again, we go back to this entire concept of it's not even the intention of BlockFi to mess up or do anything nefarious. It's just the fact of the matter is that they loaned out a bunch for overpriced miners to miners that can't afford to pay it back during a bear market. That's pretty much where you end up. After days of speculation over its finances, including a supposedly leaked balance sheet that purported to show the company suffered a net loss of $221 million amid 2021's bear market, BlockFi announced it got a $250 million credit line from FTX. Many called it a bailout because it is. The lender has not responded to CoinDesk's request for comment on this story. Companies like Celsius, BlockFi, specifically BlockFi and even New York Dig, when they were financing people at 75 to 80% LTV, loan to value at $65 per terahash or higher, many of them were much higher, towards $80 a terahash, have built horrible credit for the industry because all those loans are underwater today, Van Hughes said. Loan to value ratios are used to assess the risk of a loan by comparing its value with that of the underlying collateralized asset. The higher the ratio, the higher the risk, which often translates into higher interest rates. Broadly speaking, in the past couple of years, interest rates for equipment financing loans for Bitcoin miners usually are in the double digits, between about 10% and 19% publicly traded miners filing with the SEC show. For comparison, even after recent increases, home mortgage rates in the US run in the low to mid single digits. An $80 price tag for a terahash of mining power looks high, considering that application-specific integrated circuits are now selling below $60 a terahash, and it's actually lower, right? What are we getting over here? Let me get this calculator up. If we don't, right, so let's go over here, 4,600 for 110 terahash. So 4,650, right? Or do this backwards. Is this right? Divided by 110. So you're talking about right now on BT miners, which is not necessarily a cheap site, right? They aren't doing it in bulk or anything. This is the best site, obviously, if you're a home miner or somebody that's smaller trying to get stuff. And you can check out the affiliate link down below. And clearly they are a sponsor. All that out of the way, I'm getting the pricing from them. They're $42.27 per terahash right now. That is much, much, much lower than what most of these people were taking loans out. And it's a retail site, which means they have more overhead. Okay. You end up in a very precarious situation here because, like, who are they going to sell those miners to? Like, they're not going to sell them out to other people because they'll just go to BT miners and buy them from there. Right. Like, they would take such a massive loss on that underlying asset. It's not going to be good. They're going to have to hold on to it. They need to be in a cash position where they could handle the bear market if they were purchasing miners. At least if you purchase miners at $80 a terahash with cash, you don't have this problem. But this is where you end up, right? And so I want to make it extremely clear that this is kind of what's going on and is much lower than even what they're reporting over here, even though this came out today. That suggests now where only the initial loans give out risky, but the value of the underlying asset has significantly decreased, right? So some lenders took on more risk than others in terms of protections that they have in place in cases of defaults and how they calculated LTV, Wright said. LTV can be calculated with the value of Bitcoin or machines at the time of the loan is given out. But a lender should consider what the actual liquidation price will be when the time comes, he explained. BlockFi and New York Dig were given out very large loans while quite late in the cycle, said another industry insider who did not want to be named while commenting on other companies. This would mean that the price per terahash and therefore the monthly installments are higher. There are lenders in the market that are very exposed and very worried, the insider said. BlockFi declined to answer a list of specific questions from CoinDesk. Who do you think's very, very scared, who just took out a huge loan from FTX, who obviously has also been behind the Celsius shorts? Somebody's playing favorites over at FTX too. Look, I can't make any valid accusations there, okay? That's fair. I don't have any proof other than these two factors. One, they're intentionally trying to short Celsius. And then two, they are giving out massive loans to BlockFi. It's bailing them out, essentially. This is just all turning back into traditional finance, especially as it pertains to these centralized entities. Do not support these people in participating in these types of activities. It's just so frustrating. Chief Risk Officer Yuri Mushkin said that the firm runs a diversified lending business to the crypto ecosystem, of which mining-backed loans are only a portion. Mushkin added, these mining-backed loans are collateralized and we follow the same prudent risk and underwriting practices that we implement across the rest of our institutional business. Yeah, because you are just basically trying to force crypto into the same bucket, the same square that everything institutionally is already done. And the entire point is that wasn't working. So why are we trying to do that with cryptocurrency, right? The New York-based lender signed off a $70 million loan for Ergo blockchain in March and a $37 million credit line for Bitfarms on June 14th. Along with the loan, Bitfarms said it was selling off 1,500 Bitcoin. Just a week later, the miner said it had sold another 1,500 Bitcoin to pay off its other debt from Galaxy. So they're selling all this at massive losses. TeraWulf also took a $15 million loan in the form of convertible promissory note on June 13th. If the economics don't change, it's just a matter of time until some miners default, while at the same time lenders have relatively little recourse to save themselves because the value of the collateral, usually mining machines or Bitcoin, is dropping every day, the insider said. Celsius recently halted withdrawals for customers without much explanation, triggering investigations from authorities in several U.S. states. BlockFi, like Celsius, was working with funds raised from depositors, which means that it has to pay them back, whereas New York Dig raised money through equity, so it will just take longer for it to recoup those funds, said Van Hughes. Only about 6% of Galaxy Digital's $5.3 billion assets are related to mining, or $301 million, which would normally include loans receivable, according to a quarterly earnings report. The filing also detailed that the firm has prepaid $89.9 million in mining expenses and deposits, leaving about $211 million that could be the lender's exposure to mining loans. A spokesperson declined to comment on the figures. Miners have been selling Bitcoin to exchanges at record paces. In May, Bitcoin miners sold over 100% of their monthly production, compared to 30% between January and April, said Jaron Mellerud, senior researcher at Arcane Research. On-chain information platforms like CryptoQuant and Coinmetrics have noted record flows of coins from miners to exchanges over the past few weeks. This is not necessarily an indication of selling. It could mean the miners are staking their tokens or preparing to sell, Wright explained. With tight liquidity, miners that pledged Bitcoins they mined as collateral to get equipment loans might not be able to monetize them for anything other than paying off their debts. In these cases, the collateral is likely held by the lender and will only be sold in the case of a margin call, Bolovic said. This was the case for Block Fusion, which had a margin call at $29,000, according to the firm's CEO. A margin call occurs when the value of a borrower's collateral falls below a certain threshold determined in the agreement with the lender. In that case, the borrower has come up with the funds to exceed that threshold. If they just called me for a little bit of advice and they asked me, what would you do if you were basically setting yourself up to borrow and what's your threshold? I would say definitely my threshold is down around 20,000, right? Like I don't want to be liquidated till then or get a margin call till then. Block Fusion had to choose between posting more collateral or selling its Bitcoin, Martini said, adding that most miners he knows lost their collateral. At the same time, firms that raised money by taking on debt or diluted their stock by issuing more shares have restricted their ability to grow at this time because they have to either post additional collateral or liquidate their Bitcoin holdings, said Matthew Schultz, executive chairman at CleanSpark, a Bitcoin miner that bought existing contracts for 1,800 machines this month from another peer. We were presented with the same opportunity as everybody else, Schultz said. CleanSpark had the chance to leverage Bitcoin for the benefit of a little bit of cash flow and then to see competition raised to the point that it becomes almost unrealistic, he said. But the company avoided that and has the second lowest debt to capital ratio among surveyed miners. To secure a $35 million loan from a venture capital fund earlier this year, CleanSpark instead collateralized its Bitcoin mining rigs. Bitcoin miners that posted their machines as collateral are faced with a different set of problems. With miners looking to offload their machines for much needed cash, the prices of ASICs have significantly dropped. Ideally, miners would sell older machine models, but there is no market for them at the moment because they're unprofitable, said CleanSpark's Schultz, so they are forced to sell newer equipment or leverage their Bitcoin. Rack space is a limiting factor for those looking to buy up rigs. If a firm that mines for its own account went bankrupt, it couldn't mine at its site because it would be out of cash. So even if a lender wanted to take over the machines, they would have to find a hosting site to plug those machines in, Van Hughes said. But all hosting sites are maximum capacity right now, he added. One US-based mining hosting firm told CoinDesk that it has been getting an increasing number of calls from near-desperate miners looking to house cheaply bought rigs. But the host's facilities are completely full, so it can't take any of the offers. In an even more precarious spot are mining firms that took out loans secured with future orders, meaning contracts for machines that have yet to be delivered. These miners have to pay off rigs that aren't making them any money at the moment. Lenders and borrowers saddled with big loans against purchase orders are in a tough position because not only has the value of the machine significantly dropped, but the equipment is not even in the US at the moment, Wright said. I don't see how you can survive that, Van Hughes said. Some miners may have to take on additional loans to buy rigs for which they already put deposits. A sample set of public miners still owe $1.9 billion this year for ASIC purchases that they've committed to, said Galaxy Digital's head of mining Amanda Fabiano during a panel discussion at Consensus 2022. Regardless of what collateral miners used, its value has decreased in the past few months, Galaxy Wright said. I haven't actually seen a big difference between miners that pursued Bitcoin-backed loans as opposed to ASIC-backed loans, and I don't think you would, right? You wouldn't want to set either one of those up unless you're, of course, doing it now. But then, of course, there's the problem with space, but that space should open up as well, too, because basically we're going to have a whole bunch of miners that default and can't run their miners anymore, try to sell them all off, and then you end up at eventually having the opportunity to buy buildings that are already ready for you to set up a massive amount of mining rigs. So once again, the opportunity is here and now, right? Industry source to whom CoinDesk spoke agreed the industry will consolidate in the coming months as weaker players are forced to offload assets. This will not only bring opportunity for the other players in the form of cheap ASICs, but will make it easier for those still participating to mine Bitcoin. As less efficient miners go offline, the lower network hash rate will directly benefit high efficiency machines with low shutdown prices. That's what we were saying earlier as well. The difficulty of mining a Bitcoin block and reaping the rewards automatically readjusts to keep the time required to around 10 minutes. The higher the network hash rate, the higher the difficulty. The next difficulty adjustment is expected to make it easier to mine a block as miners have dropped off the network. And this is also happening with Ethereum that we're going to be talking about too today. Mining rig deliveries are still coming online, which will drive up the hash rate later this year, said CoinShares analyst Alexander Schmidt. At the same time, rising natural gas prices are putting additional pressure on margins for companies like Marathon Digital and Hut 8 that rely on this resource. And that's a new one that I wasn't aware of that I need to research, and we'll get into that maybe tomorrow. Miners powered by 100% renewables may benefit from lower competition. Moral of the story is pay attention to the halving cycle, especially if you are looking at buying off of credit. And secondary to that is, like, obviously from my perspective, I don't want to buy off of credit. I want to buy off of cash. Of course, cash flow at this time is extremely difficult. So what do you end up doing? Do you end up trying to liquidate your cryptocurrency to buy hardware, or do you wait for that price to go up because you're in a weird position where right now hardware pricing is the best, but also the revenue you're making is the worst. So you end up in a very precarious situation. I know I'm working on power first right now, and I think this is a great time to be doing it because obviously shutting down rigs and stuff like that to move them and whatnot is kind of the best time. So that's where I'm at right now. I'd like to hear some of y'all's thoughts too. We'll get into that in the question and answers. Thanks for checking out this clip from the Crypto Mining Show. You can check out the full episode here or more crypto content down here. Also, I'd like you to check out my locals page at sonofatech.locals.com where you can become a member for free or choose to be a $5 a month supporter that unlocks additional content.